Owens. Welcome back to Street Smart Success.
Thanks so much, Roger. I appreciate you having me on the show again. I think we talked earlier, and you said you were going to have some hard hitting questions, so I'm ready. So I'm looking
Listen,
forward to the conversation. It's always great talking economics and real estate with you on these things.
Matt, I've saved some of the hardest questions that I think I've asked anybody for you today. Are you ready?
I'm a little nervous, but hopefully I know the answers to these things. I will tell you if I don't think I have a clue.
Oh, I don't know why I'm laughing. It's only funny to me that the whole thing was a joke. Okay, well, Matt, it has been, we were in pretty constant, not incredibly frequent, but constant contact. So for sure, I know what you're up to. But, for the sake of the audience, inevitably there are people listening. I don't think we've done a podcast together in a couple of years. So there are people inevitably that aren't familiar with Mr. Matt Owens. So just give me the quick background and where you're at now.
No problem at all. Appreciate it. So just to give you that background, I'm a CPA. I quit my CPA firm job in 2006 to go into real estate full time. Since then, we've flipped a little bit over 1,000 houses. I have about 35 million lent out to flippers in different markets around the country. I've raised a little bit over 150 million for different real estate and private equity type transactions and private businesses that we invest with and things like that. And I focus quite a bit now on the mobile home parks, debt structures, and other aspects of investing that are a little bit less operationally focused because I got a 6-year-old and a 9-year-old, so I've slowed down on the flipping and things like that, which is heavy involvement type, very difficult to navigate on a scaling approach. To much more scalable type businesses where I can work with operators and help with operations in a lot of ways to mitigate risk on the investments and find the right types of strategies to invest with so that I can diversify and invest a little bit more passively because I just want to play basketball with my son outside and get beat up by my daughter, which is pretty much on a daily occurrence now. So the other day she sat on my lap for 30 minutes pretending like she was a vampire and seriously trying to bite my neck. So it was an interesting occurrence. And I told her, you can't really bite my neck. And she's like, yes, I can. So she's 6. So good luck with that one.
So yeah, so you can't be flipping houses actively and having your playing basketball and getting bit on your neck by your daughter. Okay, well you know what, I totally get that. Tell me, you said mobile home parks and debt structures. What does debt structures mean?
So have grown to love debt because from one side you have mobile home parks and multifamilies and single families and self storage deals and things like that that all produce tax benefits, cash flow, value add, wealth building effects, and usually a little bit less cash flow in the first 2 years of those investments. And while you do your value add structure, and then I like to counterbalance those wealth building aspects with short term debt instruments or debt strategies that I utilize to create cash flow streams right now so that way I can make interest on my money right away, and I help other investors do the same thing. And some of those strategies are, I am a fix and flip lender where I will lend capital to flippers in different markets around the country, and I make interest on those flips, and then I make a little bit of arbitrage on the interest on my investors' capital by helping them to do that as well. And then I call it the Be the Bank program. So basically, it's a simple idea of be in the bank's position. And right now, with the lending interest rates being higher, it kind of makes sense to kind of shift into the lending market quite a bit and be able to kind of join them. If you can't beat them, join them, right? And so that's one debt structure we do. We're also about to launch another fund that basically invests in mobile home debt, where we are lending against the actual individual mobile homes, but also collateralized by the parks in themselves and getting paid interest on that type of debt as well. I also do accounts receivable financing strategies, as long as I'm looking at the collateral balance, the value versus my underlying cost of that asset. That's usually what I look at as protection, just like I do on a house loan where I'm lending on a house. I'm looking at what's the value of that asset versus my cost or my loan amount to protect myself. So when you're lending on accounts receivable financing, you have to look at the value of that receivable, or I'd say the collectible value of that receivable in pooled situations to protect yourself in that kind of instrument. So, but there's some great strategies to develop immediate cash flow streams to cover all your expenses on that with debt. And then on the other side, build long-term wealth with the equity type investments that are in place right now as well. And I kind of use both to counterbalance. And my goal in life is to drive around in an RV with my kids and work from anywhere. So, that's the structure that I'm building for myself at the moment. So it's kind of exciting.
Okay. So, first of all, let me clarify. So you're lending, in terms of the mobile homes, you're lending, let me see if I have this. Are you lending money to operators for them to buy homes that are going to go in the parks that they own? Is that what you're doing?
Correct. Correct.
Okay. And
Exactly.
you've got the park as collateral.
Correct. The home and the park is collateral. So correct. We get the title to the home plus the park. Now the title is great, but I don't want to be collecting from a bunch of individual mobile home park owners. So that's why the park is in second loss position there to be able to make sure that we are able to get our funds back. And based on the cash flow of the park as a whole. Now they get to go in and take over that unit and re-rent it if it goes into default and do the collections of that, of course, as well, so that we don't have to do that aspect of things, of course. So
Are they loans by the home, like you would lend against, go ahead.
it's one promissory note that can be modified to add additional costs and additional collateral involved in those notes to each individual park. And we're very picky. We're actually only doing it for homes that we and our team are operating at the moment as we launch and everything, because of the fact that there's a whole nother level of risk when you're dealing with outside operators and the analysis of those operators. There's some great ones out there, but at the same time, we're taking this one slow, making sure, just like on any investment, it's everything's working. We have all the systems down perfect and everything, and we have a ton of experience in lending and doing these strategies already on individual mobile homes and understand how it works. It's just a matter of, we have 200 plus units already that are needed on multiple parks that we operate and work with already. So we're starting there first before we expand the other operators and things like that, which we've already got interest from a ton of operators that are going, wow, there's a big need in the space. So if you can find ways through your investments to fill a hole or a gap in a specific space, there's a lot of profits to be made. I'll give you another example. Someone that I know created financing specifically for wholesalers, right? And most wholesalers, they don't have the money to take down that property right away. That's why they got to wholesale it off and to make their profit, and they got to close escrow on the sale at the same time they got to close on the purchase of their unit to make their profits. And so a company came out to finance the purchase of those wholesale properties for the wholesaler, and then they have 90 days and they take title to the asset and charge some points and fees, and they charge a percentage of the wholesale fee, and then they're able to take down all the wholesale costs. And if they don't sell it within 90 days, then them as the lender have the power to take that unit and go resell it in their database as well. So really, but they're adding transactional financing. They're getting paid a great amount of money and good profits to do that and help that market out, which is a big issue. And they have the analysis capabilities and understanding of how to analyze these types of deals to make sure that they're being protected on their own capital and they're not making a mistake on lending on the wrong property. So
So to back up, you're doing AP financing as well. Is that what you said?
yes, accounts receivable financing, correct.
I'm
Right.
sorry, AAR. And so is that basically factoring?
Yeah, basically. So and what we're doing is we're able to, out of a $2,000 cost, we're able to create an $8,000 receivable or collateralize an $8,000 receivable. So on a $5 million raise, we're collateralized by $20 million worth of receivables that is $16 million, 80% historically collectible. And so there's a massive windfall of potential profits there, or leverage space, I'd say, or equity in that collectible value, to make sure that we feel we're protected at 25% of the receivable balance and 30% approximately of the collectible balance. So if that makes sense,
Are
that's how
the
we mitigate risk.
are the receivables in the business model, are these uh, um, business to consumer receivables or business to business?
So these receivables are from they're legal fee receivables, basically collateralized, and we're collateralizing the legal fee receivable by the company that is doing all the legal work. So we're basically coming in and collateralizing and doing the loan to them, and secured by all of the receivables that are owned by them, with UCC filings and all of that stuff, to make sure that we're protected there.
Typically 60% of these receivables get paid.
80
80.
historically. 80, right.
80.
In this particular type of legal fee receivable that we are collateralizing. So took a lot of homework to look at the data on all these things and make sure that everything was documented, and that we have the right type of receivable that we are lending against, right? So different types of receivables have different types of collectible ratios. So it's important to understand what those ratios are. If you have car notes, for example, there's a different receivable ratio than credit card debt, than legal fees, than house payments and things like that, right? So it's all a percentages game, and you got to look at the data to know the collectible ratios of these things.
Are you Matt, lending money to the attorneys? Is that who you're lending to?
It's a company that runs these, that hires the attorneys to do this work specifically. So it's basically, they're the one that set this system up to be able to do this, and that's what's occurring. And they bring in the legal team to do all the work for them on staff.
I see. What's the average size of the receivable?
Around $8,000, with about a $2,000 cost. So on 5 million, that's 2,500 contracts. So that's a big pool, and you get that safety in the pool. Any one particular debt could be an issue, right? So these are some of the things that I think are unique to this receivable specific investment strategy, right? Versus real estate and the other, typical strategies that you see out there. It's just a unique thing to take a look at.
I see. Sounds totally niche. What are the what return do investors get? How is that structured?
So in this kind of case, we're looking at 20% returns to investors, which is awesome. So and they get paid on a monthly basis in this case. Obviously, if we're going to be launching a 506c in the future. If I don't know you already, we have a current 506b that should be closing soon. And obviously, you won't be able to invest at all if I don't know you already. But in the 506c, they'll be coming up again. So it's kind of interesting, because most multifamilies and mobile homes and all that come short on cash flow in the first beginning years. This one is a unique way to create a 20% cash on cash return starting in month one for investors, for up to a 3-year period of time, which is really a unique strategy in the market right now that you don't see a lot. Even in my debt fund, when we lend on promissory notes and things like that, it's not at that kind of a level. But that's because it's a receivable balance and not backed by real estate, which is a hard asset, right? So there's a more risk involved. You got to look at the pooling effects and the collection ratios much more closely in an investment like this when you do your homework.
So or does it start the clock starts ticking right out of the gate? I give you 100 grand and I get 20 grand year one paid quarterly or whatever, how is it all?
Right, right. It's paid. We actually pay it out on a monthly basis, because once you pay investors capital on their return starting in month one, a lot of times the trust is built there in their eyes, right? So we're trying to build trust as fast as possible, and I always recommend wait a while before you reinvest more capital and things like that. Get to know an operator, how they communicate, how if things are working on time and all that stuff before you invest more money. But it's a huge benefit for us and for the investor to get paid right away in that kind of a scenario. So But yeah, it's this strategy, along with any kind of debt strategy, is unique. And there's other debt strategies that can get you to that kind of level when you're investing in even when you're investing in fix and flip construction debt. Normally, people are lending at 11 to 12%, sometimes even up to 14% on construction debt, and that's the max you're gonna be getting on this. Maybe you got some points, but you're really getting paid for your time when you're getting points, right? That's really the workload type, not a passive investment type when you're lending on construction loans. You got a lot of homework up front on those deals. But some outside funds, we don't do this in house, but some other outside funds, what they do is they will leverage those loans. So they might have $20 million worth of loans, and they'll go to the bank and say, hey, I want to leverage this package at $10 million or $15 million out of the entire pool of debt. And what happens is their debt is usually a little bit less than what you pay investors, and because of that, you're able to add leverage to it. And if you have 12% money out there and you have bank money for 75% of it or 50% of it at 8%, your arbitrage rate shoots up through the roof, right? I'll give you an example. I did a loan inside my 401k for $500,000 at a 14% interest rate. Flat rate, no points, nothing else, at 65% of the value of that asset to protect myself. My 401k then sold that loan. It sold $450,000 of that $500,000 loan to another investor at an 8% interest rate. And so on my $50,000 left in the deal, if you do the arbitrage, I'm making 14% on the whole thing and paying out 8. That's a 68% return on investment for my $50,000 left in the deal. And that stuff is the stuff that gets CPAs super excited about investing in real estate and debt and stuff like that, when you can see that type of structure in place. And that's what these big funds do, maybe not at a 90% leverage ratio in that kind of situation, but that's what they'll do. Sometimes they do 90%, and then they'll pay investors like 15, 18% on their funds in those types of situations from lending because of the additional risk that's involved. The problem is that there's a major market crash or correction, then that 10% money or the investor money is what takes the hit first in those leverage type of situations. And if you have a massive default rate, you could be at risk of losing the entire portfolio. And so it's very important to manage your leverage ratios very effectively to make sure that, hey, you could take a hit of 50% and still perform on the portfolio and investors don't lose their money, So those things are really important in my eyes, especially nowadays where I feel like there's a lot of risk on the market right now overall and in the economy, and it's important to invest to protect the principal first and then return on investment second, and of course I'd say the operator even first, or second or first in that space, because the operator is the one that's going to help you mitigate those risks. So
To summarize where we're at thus far, Matt. So basically, correct me if I'm wrong, you're replacing your time and effort that was previously allocated towards flipping, which is very operational and very hands-on and inevitably time consuming and probably stressful at varying points along the way. You're replacing that endeavor effectively to more passive stuff, which includes raising money as well from other investors, and you participate alongside them in these passive mostly, maybe not entirely, basically debt vehicles. Is that a
yeah, and I'd say that the only reason that I'm able to be more passive in these types of instances is because it's more of a scalable business where I can have my team members easily step in and do some of the administrative stuff, which is a less of a burden in this case. And I'd call myself an active GP in every deal that I do. I'm not a passive limited partner just raising capital for these. I'm actually creating and structuring the entire financial model on these projects that I'm working on, as well as helping and performing asset management work and implementation work with even the operators that I utilize to do a lot of the active operations work on the ground. Like, for example, in the mobile home park debt fund that I'm doing, I was the one that did the financial model and went through and dealt with all the legalities and the legal structure in each individual state, and made sure that we have the right brokers involved, and that I'm dealing with the legal docs, and I'll be helping manage the portfolio of the fund. But I'm using my team internally to do a lot of that, which enables me to have a little bit more time freedom on this as well. And I can do larger deals and make the same amount of money. It's just 10 times more efficient than being a fix and flip investor. And I think I just did a YouTube video on how I lost $50 million on actually flipping over 1,000 houses now, because they all went up at least $50,000 since if I would have held them all. And it was an interesting wake up call, to say the least. But it's at the same time, it made me a specialist at a lot of this, and understanding risk to a whole nother level, because I've been through so many transactions and seen every potential risk that could come up, and they still get punched in the face every once in a while, but most of the time I'm able to mitigate a lot of these issues that come up and see those risks from an operational perspective. And that's, I think, one of the biggest values I bring to the table, is showing these other operators, here's how we mitigate risks, and structuring deals so that the risks are mitigated on all fronts, before I invest or bring in other investor capital to a deal.
In terms of like your endeavors and amount of like time, energy, focus, where is the bulk of, like, what would you say is the number one? Because you're a GP in a number of different entities.
Mm-hmm.
You still have your debt fund for flippers. Where is how would you break out where you're spending your time?
So I would say that, does email count? Can I put that as a category? Because I'm
Sure.
tired of the email, but no, I'm just kidding with you. So no, at the end of the day, I think, as I slow down on the single family home space, most of my stuff is focused on the lending business, as well as some other of the GP deals that I've done, just managing from a higher level, consistently looking at the asset management side of things and the efficiencies of those businesses, handling meetings with my teams, and consistently having, goal settings and running the business from a higher level than necessarily involved in any one particular aspect. The shift has happened already, as far as focused on lending and lending structures, and just doing one large syndication, another large syndication, another large syndication, primarily related to debt on a one-off situation. I may have at any one time 2 or 3 projects in process, but usually only one launch happening at a time from, a particular deal in place, and they may happen once a month or once every 2 months or something along those lines on those launches, which I make the same bang for my buck in this type of space than I would flipping houses, especially if you consider the time of that, and it's 10 times more scalable. And I'm dialing in the marketing to a whole nother level. I never learned this much marketing in my life, these strategies that I'm utilizing now. It's pretty cool.
Um, would you, in terms of the lending, the overall lending activity, what you've been doing for a number of years is against house flipping. Is that requiring less and less of your time, I guess, or your team members stepping up? And then are you allocating more time to some of the more recent engagements?
Yes, and we've actually changed some of our strategies for our lending as well, where we still have a core group of people we are lending to in-house, for operators that have been with us for a long time, but that takes a lot of servicing on the back end, from loan management, from project management as a whole, as well as communication with borrowers, closings, and funding deals and things like that consistently. And so we've cut back on the direct lending and are only dealing with people that we have already a pre-existing relationship with, instead of new people, which stops a lot of the headaches that come in from dealing with new people. And a lot of 50% of those types of loans don't close if you're dealing with the wrong operators. And there's a lot of lack of sophistication in the single family space. And then on the other side, we are now buying debt as well, to be able to do this, and we just forgive our points on the front end for doing that workload, but at the same time we get a full package done for us as far as the due diligence go, which we do our own homework and due diligence on in depth, but it's a lot easier because the loan is already closed, and we can pick and choose which loans we want to purchase or invest in, and structure the deals in different ways with broker buybacks and stuff like that, where they'd be required to buy back the loan from us if it goes into default, etc. Things like that to protect ourselves and mitigate the risk, and pick the loans with the loan to values we feel comfortable with as well, without having to do the direct borrower to borrower transaction, which is very heavy lift, very similar to flipping houses, right? You better close on time and get it immediately done and get those funds in, and then if you have more demand than you have capital for, you're kind of in this juggling match going, okay, well, I want to fund these to make these clients happy on the borrower side, but I don't have the capital yet. Let me go raise the capital for this so that I have the funds to do that. And so that kind of stress and that pressure, I'm just like, let's alleviate that completely and buy the debt when we have capital available to do it. And it makes a lot more sense, especially when we're dealing with millions of dollars of capital. We have a lot of power to be able to help a lot of these different brokers out, or these, pick and choose specific brokers that we want to deal with, so that strategy helps us to be more passive as well by dialing back, even though we still have some active operations on that, with operators that are, in place. They're reoccurring operators with us where we don't, they already know our systems, they know the processes, we've never had problems with them and things like that. So it's a lot less workload on those operators than it would be newer operators, or I'd say less sophisticated fix and flip investors to work with, right? So I love being able to do that and be able to shift this way, because I just get to spend more time with the kids, when you do that. And I really love being able to focus on bigger projects like a bigger mobile home park, or our mobile home debt fund, or this, accounts receivable financing funds type stuff, because it's one-offs at a time. The pressure isn't super high or anything like that. Yeah, we want to get funds in on time and things like that, but we can take our time and do the due diligence on operators and take 6 months. And I invest first usually with operators before I ever raise for them, to test their communication skills. And I usually will. It'll take a year sometimes or more for me to raise capital in a structure for somebody, because after running a property management company and a lending company, the trust doesn't go too far. You know what I mean? So you deal with a lot of crazy people.
Yeah,
So,
and you've seen the movie. So
yep.
your goal is to gradually, it sounds like, migrate away from the hard money against flippers. It's labor intensive. That they're smaller loans, or not big deals. You have some legacy clients in there that you're continuing to lend to,
Right.
because they're probably a little bit more efficient than onboarding somebody new. But it sounds like ultimately you see yourselves migrating away from that to bigger deals. Is that correct?
Yeah, I mean, so I really love the direct promissory note funds against single families, because of the ability to scale that now, especially if we're buying the debt. We're at 35 million. I think we can get up to 100 million dollars in this structure as well, by just buying the debt consistently. It allows us to scale, and make it even easier to hire even more people to come in and just do every aspect of the asset management associated with that piece for me, to be a lot more free for myself and my time. So,
Hmm, I understand. In that business, by the way, are fewer people, is what is the trajectory of the business, only from the standpoint that as prices go up, are are flippers buying fewer homes because it's harder to make money?
yes, so we are seeing a lull to a degree, but there's still a lot of activity out there, and we're still seeing people get deals at 50 cents on the dollar sometimes, and 65 cents on the dollar or less, quite a bit out there. It's still, it really, if we have capital to lend, we're getting hit up by borrowers consistently. So there's no lack on our end if you have the capital available, as long as you're out there and known to people that you're a lender. People will come to you. And we have a massive affiliate system, so we can always go through and turn our affiliate system on, and get as many borrowers we wanted to at the end of the day. So I don't think there's a lack of supply of borrowers out there, especially when you're dealing with multiple markets around the country and things like that. So
Hmm. Um, okay, well, that I totally get. On your site, just briefly, you've got some like opportunities that look like they're syndication. Just a couple. One is for like a multifamily in Memphis. One is retail in Barstow. And tell me where the origin of those are. Those just people you know that are acquiring those, and you're just raising
So
money for them, or what
I
are?
put those on there as examples of some of the deals we've done in the past, where we've bought these buildings, we've renovated these buildings, increased the value, and sold these buildings, and some of the deals that we've invested with in the past. And so that's on ocgproperties.com. I also have another website, which is MathewOwens.com, which is one T in Matthew because my parents couldn't spell. I'm joking, of course they could
I
spell,
know.
but so. But at the end of the day, I utilize that to show people the types of deals we've done in the past and things like that. Those aren't active deals. I don't typically market my active deals. I want people to get to know me first before I go out there and start, blasting out deals to people. In any kind of 506B investment, I have to have a pre-existing relationship with somebody for them to invest anyways in those deals. And I've done a lot of 506Bs, and then I also starting some 506Cs, which allows me to market to the general public, but at the same time, I have not pushed things out like that yet to the general public. I really like to go to my base of investor first because I like to know my investors personally and make sure they're the right fit for investing with us, because people have different personalities. Some people are sophisticated, some people are not sophisticated, and I just want to make sure that they are set financially and able to actually invest correctly and are being financially prudent in their decision making ability and their ability to do the due diligence. So we give out due diligence sheets or a 200-point due diligence checklist that we have on our sites for people, because I want people to do their homework on every investment they invest in first. So that's why I don't, necessarily go out and blast this out to people that are not in my direct database. So
I do know. How many, just roughly, how many entities, opportunities, however you would want to define it, would you say you're in that you're participating in, that you're raising money for currently?
So right now we're about to, well, probably three different projects that we're working on. We have packages of single family homes. We have our lending business, lending to flippers in different markets, and then we have our debt validation fund, and we're about to launch that mobile home debt fund as well. So that'll be four different, potential opportunities. And I find that it's easier for me to raise capital when I have a diversified pool of assets to invest in, because different people have different goals. Some people want tax mitigation by investing in assets. Some people want consistent immediate cash flow by investing in debt. And some people are comfortable and want a higher return with, an accounts receivable financing versus I'll say lower risk financing on a single family house construction flip deal, right? So those types of personality differences enabled me to guide people to the investments that I think would fit best for them based on their personality and their risk tolerance levels and goals in mind. I don't want to go put somebody that's 85 years old and have them own a bunch of single family homes where they have to manage the property manager and things like that every time. It's too much work for someone like that, right? So that's I'd say something that I think is important to assess on each individual investor before you allow them to invest with you.
Hmm. Tell me, what is the status? Because I do know you just mentioned like packages of single families.
Yeah.
What is, just curious, that was intriguing to me. I think we talked about it maybe a year ago. What is the status of that? Those were, you were basically just going to group together your personal portfolio and then
Right.
bring in. Are you doing that?
So we are right now we are moving forward with a short-term rental fund that we are moving to with our property management company that's actually managing these units right now for us for these short-term rentals because they're doing such an awesome job. So we're putting a big package of our short-term rentals as one big fund there, and then we're afterwards putting together a package for a bunch of our single-family homes. The issue comes in when a lot of these single-family homes you have debt in the 6.5 to 7.5% range, and the cap rates at market values are 6 to 7 in themselves, and so it's harder to hit the right cash on cash return. And you're just basically adding, interested in investing in pools for that long term wealth building effect, which they may not cash flow the most amazing right now. They might be 6-7% on the funds as far as a cash on cash return. But I look at it as a major inflation hedge long term because I don't see a way that the government's going to stop printing money. We might have a short term volatility because of a crash in the banks or a liquidity crisis, which I think is a higher risk of occurring or very similar to risk to 2008, where that we may have a liquidity problem with some of these bigger banks internationally are very intertwined globally now, and I think that it might be a black swan event to hurt the U.S. market and cause a potential mass unemployment type situation. But it's all relative. It's all percentages, and we don't have the same real estate systemic lending risk that we did in 2006 through 2008 when everything started crashing with bad loans, but they're starting to get there. So you look at now Fannie Freddie coming out with a loan program to do second position standalone mortgages for people, and you're going, well, what could go wrong by this, right? Just giving people more money out of their house and letting it draw in a second position at higher interest rates because of where the rates are right now. And so it might add liquidity to the market by tapping into that equity and kicking the can down the road, but it's also adding additional risk. There's a lot of equity out there right now, and so they want to tap into that equity to make the market look strong probably before the election, occurs, because it's all political. So it is what it is, right?
That's for our next podcast.
Yeah, yeah.
Okay.
We can talk about my water barrels and food storage when an entire collapse occurs later on, So
You'll be the guy that's laughing hardest.
yeah, yeah.
Where are the short-term rentals and how many of them are there?
Right now we have a package of about 20 to 25 that we're working on, and most of them are in the St. Louis market, higher end houses in these markets. I like that St. Louis market because we can get big houses that are older, renovate everything, every part of them, and all systems down to the studs and everything. We can get a good cash flow stream going from those and hit 10 caps or better on the short-term rentals on higher end houses. And it's a market that has a lot less volatility. It's known for higher crime in some of these pockets, but we don't invest in those areas. We focus in, higher end houses that are, bigger houses that house families of 16 plus, and we're doing all the little bells and whistles. I think in one of the units we're looking to put in an above ground swimming pool and jacuzzis and a batting cage in one of the basements and things like that, the things that pop out from a marketing standpoint, so even though St. Louis doesn't have the best rep from the crime standpoint, we don't deal with most of that because we don't invest in those particular areas. I like it because there's a lack of volatility and market fluctuations, and I feel like the downside risk of that market is less than some of the other ones because of the affordability in that market, from a acquisition standpoint of new homes and to the income that's in the market.
So I'm one of the few people you'll talk to that's actually spent some time in St. Louis.
Okay,
Um,
nice.
I love St. Louis, and St. Louis is a cool town. A lot of people don't know that. But I have to ask. But what you're describing by at the same time is that, like, who the heck though? It's still like not a place you go for vacation though.
Yes,
Who
yes.
the who the heck is renting, a big monstrous home? I mean, like, I get it in Scottsdale where it's a buddy's
Right.
alumni weekend, golf and beer and whatever. and you got this 1,000 square foot.
It's
I get
not
so,
it's
so
not a
you're
vacation destination
all
for
right. So,
sure, right?
but I know
So
you're a smart guy, so
yeah.
I'm sure there's thinking behind it. But tell me what it is.
So it's all a matter of who your customer base is and what the competition is in that market. And so there's very little large homes
Yeah.
that house 15 people. So if you have a family coming into town for a family reunion, anything like that that occurs, then we are able to house them versus them buying 10 hotel rooms or something like that, or 5 hotel rooms or more that cost them a killing. They're getting these things for 350 to 550, sometimes $600 a night for this for 15 plus people, and we do all the bells and whistles with the game rooms, the finished basements, the popcorn machines and coffee machines, and really I'll say doll these things up from a amenities standpoint and are focused on a specific client base. And there's very little competition like this in the market for large homes like this versus 2 bedrooms or 1 bedroom units. There's quite a bit of those, but we're looking at the revenue. We're looking at what they produce in the market. And, we're seeing a couple of other pieces of competition out there showing that these homes are hitting $100,000 a year plus of revenue, which is for these larger homes. So we're looking at that and the 50% expense ratios that go into these things on the short-term rental basis to be able to determine what that looks like. So if you're unique and you are one of the only ones in the market targeting that type of client base or that specific customer, then you're going to do well in that market as long as your bells and whistles are done, your management's dialed in, and all that stuff too, of course, from the operation standpoint.
So I guess the question that just goes up in my mind, which is incidental at best, is like, okay, I totally understand that. And are there family reunions in St. Louis? Of course there are. There are everywhere. But
Right.
like, does that family is it even on their, it's even on their mind, even in their, I'm lacking the words, but it's on their,
On their
even
radar.
thank you. Thank you. Even on the radar to even think of like to me, I wouldn't even know such a property exists because I
Ah,
tend to think of right. I think of Airbnb is going to be some small like a
right.
condo or something. So how does that work? You know what I mean?
So, I mean, we get the demand. It's all based on the
Okay.
marketing side. So we're
Okay.
seeing the demand occur, and we're getting actually bookings consistently on these big units. So we're seeing it happen. And so, and we before we invest in these, we actually find 4 to 5 other listings in the markets that are just like ours that might be our direct competition, and we see what revenue they're doing. And if there's nothing close to that, then we're looking at the next best thing on the units and what they produce in cash flow. And there's data out there on AirDNA and other websites that you can get paid data sites to be able to get that data and see how many bookings they're getting, how occupied they are, what the nightly rates are, how much gross they've made over the last year and the last 12 months as well. And you can see the pictures of those listings to see how they've set it up, what their amenities are, where the locations are, and you're basically picking comps. That's what you're doing, and you're looking at what the data shows as far as those units go as well. And it's all data based, and that's why I love my short-term rental management company, because I would don't want to manage these things myself because it's a lot of work managing short-term rentals.
In that company's in St. Louis.
Actually, they're nationwide, so which
Uh,
is great, and they're killing it for us on the management side. It's a lot about marketing and automation systems and your setup processes more than being on the ground in those markets. Yes, you need your team members, you need your contractors, your cleaners, and eyes and ears on the ground there that can be there for you for emergencies. Of course, it's a matter of having the core team members there, but it's even a lot less than long-term property management in this case. So with regard to these units, which is shocking.
how much do you buy these homes and how much you put into them?
So we're typically going through, and these are, I'd say, $500,000 homes, like market value homes, $600,000 market value homes, and we're making 10 caps on them basically, and that includes the short-term rental furniture, which I'd say is, $50 to $100,000, depending on the size of the unit, as far as how much furnishing and the bells and whistles, and depends on what you put into it. If we do murals in the basement, for example, or we do batting cages or bars in the basements, all these things, and jacuzzis, all that kind of stuff costs extra money. But it really, when you look at the return on investment, just for example, having a jacuzzi or not having a jacuzzi, even if it's St. Louis in the middle of winter, someone will pick the house with the jacuzzi before the non-jacuzzi house, and because they might think in their head while they're there, even though it's freezing outside, they might think they want to jump in the jacuzzi. So, and whether they do or not, most of the time they don't even use it. So it's pretty funny.
So you don't need to say the name, but like what we covered earlier is you are being intentional about getting out of operations so
Hmm.
that you can scale, that you can have more time with family, et cetera, et cetera.
Right.
So who is the manager? Like, how did you find the operating manager entity? Because I'm assuming it ain't you, because this sounds frankly more labor intensive than
Yes.
houses. So
Yes, and I actually met them through a mastermind group that I'm part of, the Raise Masters one you're aware of, and that's how I met them. And they have their short-term rental management company up and running, and I tested them first with a few units before, after I did a bunch of due diligence on them and saw their background and their other units that they were managing and things like that. Saw how they managed it. Spent a weekend with the manager as well, getting to know them, and then tested them with 2 units, and saw how they were performing. And every week we're seeing reporting done and all that kind of stuff come to us, which is amazing. And so once you see the performance happening, then you start to go bigger, and we added more units to them. And now we're going into business with them over after doing this with them for a while now. So it took a little bit of time, but now we're moving all these short-term rentals over, and they're actually bringing capital to the table from private investors to solidify this, and we're moving all the properties to a big fund with them. So
you know, are these guys based in St. Louis?
no, they're actually based out of Nevada, but they do all this stuff nationwide with short-term rentals. It's just a system they go set up in these markets and a specific team, and so they want to have enough of units in each market to have that system deployed. And so we gave them the initial units with the promise of more as long as they performed. I told them, you'll give you more units as long as you don't suck. So and then so they got a good laugh about that, and then they performed really well, and it was great. So it just takes time for me, because I've dealt with so many bad team members now that I want to take my time with anybody new and get to know them first, as you probably have dealt with firsthand with operators as well, right? So
You know what? Most unfortunately, yes, I can relate. Absolutely. Well, as usual, Matt, lively conversation with you. When I do a podcast with you or talk to you, I'm just like, okay, man, I just got to hold on for the ride. Um, I very much appreciate you doing this. Did either you or I leave anything out?
hey, if you want to get a hold of me, you can go to my website, MathewOwens.com, and we got due diligence spreadsheets there. We have property quick analysis sheets, master classes, all for free for you guys. So that's how you reach me if you guys want to.
And remember, just one T.
Yes, 1T in Matthew.
Okay. All right. Matt, I cannot tell you how much I appreciate it. I really do. You're a great guy. You're one of the first people I met along my current journey. You're one of the people who not lost me money, and for that, I'd give you a big hug if we were in the same room.
Nice. I'm proud to be one of on that group. Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. 3 of the key pillars to becoming a successful real estate investor. Number 2, you can join us on our mailing list, where you'll get tips and tricks on real estate investing directly to your inbox. And number 3, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.